Kentucky Derby has run every first Saturday in May since 1876. 151 years of unbroken tradition. One race, about 2 minutes. And for Churchill Downs Incorporated, it sets up one of the most extraordinary single-event revenue events in American sports and entertainment. But here's the thing. The company doesn't need the Derby to have a good quarter. Q1 2026, $671 million in revenue, beating estimates. Diluted EPS of $1.07, beating the $1.01 estimate. And the Derby isn't even here yet.
Churchill Downs Incorporated has spent the last 15 years transforming itself from a legendary racetrack into a diversified gaming empire. Today, it operates 11,000 slot machines and gaming terminals across 8 states, a network of historical racing machines in Kentucky that generate casino-like economics without a casino license, and TwinSpires, one of the largest online horse racing wagering platforms in the country. The Kentucky Derby is still the crown jewel, but the business runs 365 days a year.
Welcome to Charged Alpha. I'm Hudson Thomas, here with Lana Chen. Today we're breaking down Churchill Downs Incorporated, ticker CHDN, the Louisville, Kentucky company that owns the most famous 2 minutes in sports, a growing portfolio of gaming properties, and one of the largest online horse wagering platforms in the country. 14% upside to analyst price targets from current levels, a forward PE of 13.5 times, and a Kentucky Derby catalyst sitting right around the corner. Let's dig in. Churchill Downs Incorporated was founded in 1875 as the Louisville Jockey Club, a group of Louisville businessmen who built a half-mile oval track on the south side of the city, specifically to host a new race modeled on England's Epsom Derby. The first Kentucky Derby ran on May 17, 1876, and never stopped. Today, Churchill Downs operates with 6,480 employees and generates approximately $3 billion in annual revenue across 3 business segments.
The live and historical racing segment owns Churchill Downs Racetrack and several pari-mutuel gaming venues in Kentucky, including a network of historical racing machines, terminals that look and play like slot machines but replay historical horse races, making them legally classified as pari-mutuel wagering rather than casino gaming under Kentucky law. That regulatory structure is critical. It lets CHDN deploy casino-like economics in a state that hasn't broadly authorized traditional casino gambling. The TwinSpires segment operates one of the nation's largest online advanced deposit wagering platforms for horse racing, plus sports betting in select states.
The gaming segment is the third leg. Casinos and gaming facilities across 8 states, including properties in Louisiana, Iowa, Indiana, and Maine. Combined, CHDN has approximately 11,000 slot machines, video lottery terminals, and gaming devices, plus around 200 table games, generating daily cash flow far beyond what a racetrack alone could produce. The business that was once entirely dependent on the Kentucky Derby now generates over $650 million in revenue in a quarter, where the Derby hasn't run yet.
The Q1 2026 story is the non-Derby story. First quarter is Churchill Downs' weakest quarter by design. The Derby is a Q2 event, but the company still beat revenue estimates by $10 million and EPS by 6 cents. That performance came from the gaming segment's steady daily revenue, continued HRM expansion in Kentucky, and TwinSpires handling horse racing wagers from customers across the country. The business is more resilient than the headline focus on one horse race suggests.
Churchill Downs is led by William C. Carstanjen, billed to everyone in the industry, who joined the company as Chief Legal Officer in 2005 and became CEO in 2012. He has a law degree from the University of Virginia and spent years practicing corporate and securities law before moving to Louisville. His background turned out to be exactly right for the job.
Carstanjen is most credited for the historical racing machine strategy. Getting HRMs authorized in Kentucky required years of legal work, regulatory maneuvering, and defense against court challenges, the kind of long-game institutional effort that a former securities lawyer is uniquely equipped to execute. He won, and the result was hundreds of millions of dollars in capital investment in Kentucky facilities that now generate recurring, high-margin revenue every single day. His M&A record includes multiple gaming acquisitions across 8 states and a decade-long investment in TwinSpires. Under his leadership, CHDN's revenue has grown from under $500 million to nearly $3 billion.
The critique of Carstangen's tenure is on the balance sheet. Churchill Downs carries almost $5 billion in net debt, the direct result of an acquisition and expansion strategy funded primarily by leverage. Critics argue the debt load compresses EPS growth and limits flexibility. Carstangen's counterargument has been that the assets generate sufficient cash flow to service the debt while continuing to grow, and that the leverage is a reasonable price to pay for the portfolio he's assembled. The market is currently pricing in the skeptic's view. CHDN sits 25% below its 52-week high. Let's get into the financials.
Churchill Downs trades at $88.79 per share, giving it a market cap of approximately $6.2 billion. The trailing price-to-earnings ratio is 16.7 times, based on TTM diluted EPS of $5.31. The forward PE, based on 2026 analyst estimates, is 13.5 times. Price to sales is 2.1 times trailing revenue. Price to book is 6.3 times. EV to EBITDA is approximately 10.3 times.
Walk us through the income statement.
Q1 2026 revenue was $671 million, up 4.4% year over year from $642.6 million in Q1 2025. That beat the consensus estimate of $661 million. Diluted EPS of $1.07 beat the $1.01 estimate by approximately 6%. Q1 is seasonally CHDN's softest quarter. The Kentucky Derby generates most of the year's Q2 EPS. Q2 2025 delivered $3 per diluted share versus $1.07 in Q1 2026. So the absolute number looks modest, but for a non-Derby quarter, beating by 6% shows the diversification strategy is delivering. Gross margin was 30.3% in Q1, operating margin was 21.5%, net margin was 11.2%.
And the cash flow and balance sheet.
Operating cash flow on a trailing 12-month basis is approximately $770 million, and free cash flow is approximately $620 million. Capital expenditures run about 9 to 10% of revenue annually, higher than a pure software business, but appropriate for a company continuously building and upgrading physical venues. The balance sheet is where the conversation gets serious. Total debt is $5.2 billion, cash is $289 million, and net debt is $4.9 billion. Net debt to EBITDA is approximately 4.5 times. Interest expense runs roughly $300 million per year. That interest load directly suppresses net income and EPS, which is why the PE of 16.7 times looks higher than the EV/EBITDA of 10 times. The debt sits between EBITDA and net income. Total assets of $7.5 billion include $2.5 billion in intangibles and goodwill from past acquisitions. Overall, Churchill Downs Incorporated's financial health is watchful. The company generates approximately $770 million in annual operating cash flow on solid margins, reflecting the durable earnings power of its gaming and racing portfolio. However, $4.9 billion in net debt at 4.5 times EBITDA is elevated even for a capital-intensive gaming company. The business can service this debt load given its free cash flow, but any deterioration in gaming volumes or increase in borrowing costs would tighten coverage ratios quickly.
What does analyst sentiment look like on Churchill Downs?
Broadly bullish. 14 analysts cover CHDN. The consensus is buy. 10 carry buy or equivalent ratings. 3 are at hold, and 1 is at sell. The Street's enthusiasm reflects the view that CHDN's assets, the Derby brand, the Kentucky HRM franchise, TwinSpires, and the gaming portfolio, are collectively worth significantly more than $89 per share. The consensus price target is $118, implying about 33% upside from today's level. The target range runs from $95 on the low end to $140 at the high.
Any notable calls?
Several constructive ones. Wells Fargo maintained its overweight rating on April 16th, just 6 days before Q1 earnings, citing the approach of the Kentucky Derby and valuation support at current levels. Citizens maintained market outperform in January. JP Morgan, Barclays, and Macquarie all maintained positive ratings through the Q3 2025 earnings cycle. Susquehanna has held a positive rating consistently. What's notable is what you don't see. There are no major street downgrades in the recent record, and no high-profile sell ratings, despite the stock sitting near its 52-week lows. The bears are largely outside the analyst consensus rather than inside it.
Let me make the bull case for Churchill Downs. First, the Kentucky Derby is an irreplaceable asset. The Derby has run 151 consecutive years without interruption. It commands premium global media rights. It generates extraordinary hospitality and sponsorship revenue in a single weekend, and no competitor has any realistic path to replicating it. That brand moat only deepens with time. Second, HRM expansion in Kentucky is still in early innings. Churchill Downs has successfully established historical racing machines as a legal pari-mutuel product in Kentucky, and new facilities continue to open. Each new HRM venue delivers casino-like daily revenue in a state that hasn't licensed traditional casinos, a competitive position that is structurally protected by regulation and legal precedent. Third, TwinSpires benefits from the online wagering megatrend. Online horse racing advanced deposit wagering has been regulated at the federal level for decades, and TwinSpires is one of the few platforms with national scale. As sports betting legalization continues to spread, the TwinSpires brand in the online wagering space becomes more valuable. Fourth, the valuation reset is creating an opportunity. At 13.5 times forward earnings and a stock price 25% below its 52-week high, Churchill Downs is priced for continued leverage concerns. If the company executes on its organic growth pipeline and demonstrates debt coverage, the multiple re-rating could be significant. Fifth, the Q2 Kentucky Derby catalyst is weeks away, and management said advanced ticket and hospitality demand is strong.
The bear case has genuine weight. First, $4.9 billion in net debt at 4.5 times EBITDA is the most important number on this balance sheet. Interest expense of $300 million per year means that every dollar of operating income improvement is split between reinvestment, debt service, and equity holders, and debt service comes first. Until CHDN materially reduces its leverage ratio, EPS growth will be constrained by financial costs, not operational performance. Second, HRM regulatory risk in Kentucky is real and ongoing. Historical racing machines operate under a legal classification that has been contested in Kentucky courts and remains subject to potential legislative reversal. A ruling against HRMs would be catastrophic for CHDN's Kentucky earnings and capital investment thesis. Third, TwinSpires faces existential competition. DraftKings has massive brand awareness, a larger customer acquisition budget, and is expanding into horse racing wagering. Flutter Entertainment's TVG is a direct horse racing ADW competitor with global backing. CHDN is in a content arms race for the online wagering customer that it may not be able to win at the same cost structure. Fourth, EPS growth has been erratic. Q1 2026 EPS of $1.07 versus Q1 2024's $1.08, nearly flat over 2 years. Revenue is growing, but the debt cost is absorbing the earnings expansion. Fifth, the stock being 25% below its 52-week high is a signal worth heeding. Markets are efficient, and the repricing reflects legitimate concerns about the pace of leverage reduction.
How does Churchill Downs compare to its gaming peers?
CHDN's price-to-sales ratio of 2.1 times puts it in the middle of the gaming and wagering universe. Boyd Gaming, a regional casino operator with comparable market capitalization, trades at about 1.8 times revenue. That's a business with similar brick-and-mortar gaming economics, but without the Derby brand or the HRM advantage or the online wagering platform. Penn Entertainment trades at just over half a time's revenue, but that's a distressed multiple. Penn has been restructuring after divesting Barstool Sports and is rebuilding its online betting strategy. At the other end, DraftKings trades at nearly 4 times Rime's revenue, reflecting its hypergrowth profile and the premium investors assigned to pure-play online sports betting platforms.
So CHDN is priced between the pure brick-and-mortar casinos and the pure online operators.
Exactly, which is the right way to think about it given that Churchill Downs genuinely straddles both worlds. The valuation question is whether the market is giving CHDN enough credit for the online and HRM components versus the leverage discount it's applying to the balance sheet. Right now, the leverage discount appears to be winning. Boyd Gaming and Penn don't have anything like the Kentucky Derby in their portfolios, and they don't have Twin Spires or a defensible HRM franchise. The case for CHDN at a premium to Boyd rests on those differentiated assets, and the Street's consensus price target of $118 suggests most analysts believe the discount is too steep.
What about dividends across the peer group?
Churchill Downs pays a very small dividend, about 44 cents per year, which at the current stock price yields less than 0.5%. The payout ratio is only 8% of earnings, meaning the company is retaining virtually all of its income for debt service and capital investment. Boyd Gaming pays a similarly modest dividend. This is a group that reinvests into the business rather than returning capital, which is why the leverage and capital allocation decisions matter so much.
On the options side, formal put-call ratio and implied volatility data were not available through our primary sources for this episode. What we do know is that CHDN carries a beta of 0.65, moderately correlated with the broader market, but less volatile than the average consumer cyclical stock.
The positioning story heading into Q1 earnings was shaped by the stock's location. CHDN has been sitting near its 52-week lows, roughly 25% off its high, which tends to attract two types of options activity: bottom fishers who see a Q2 Derby catalyst as a near-term revaluation event, and hedgers protecting against continued downside if the earnings print or earnings call guidance disappoints. The seasonal concentration of CHDN's earnings in Q2 creates a predictable annual options setup. Every year, the Kentucky Derby creates a period where the stock tends to get bid up into the May event. Whether that happens in 2026 depends heavily on how management frames the Derby outlook on this earnings call.
On insider activity, formal transaction data was not available through our primary sources for this episode. Churchill Downs executives and directors operate under a trading window tied to the company's earnings calendar and the Kentucky Derby event cycle, which compresses the periods when insiders can legally trade.
CEO William Carstangen's compensation is heavily equity-based, which aligns his financial outcomes with shareholders. No unusual insider selling around Q1 2026 earnings has been flagged. In a company where the CEO has spent 14 years building the franchise, the absence of selling is itself a positive signal. And management's choice to increase capital investment in Kentucky HRM facilities and gaming properties rather than reduce leverage faster suggests confidence in the return on that investment.
The key risks heading into the rest of 2026. Risk 1, leverage and interest expense. $4.9 billion in net debt at 4.5 times EBITDA is the single biggest risk factor. $300 million in annual interest expense constrains EPS growth and financial flexibility. Risk 2, Kentucky HRM regulatory environment. The historical racing machine franchise operates under a legal classification that could be challenged or reversed. Any adverse ruling or legislative action in Kentucky would be materially negative. Risk 3, Twin Spires' competitive position. DraftKings, FanDuel, and Flutter's TVG are all targeting online horse racing and wagering customers with budgets that dwarf Twin Spires' marketing capacity.
Risk 4. Q2 execution is everything. The Kentucky Derby is CHDN's most important financial event. Any disruption, whether regulatory action, racetrack incident, to the May Derby weekend would have an outsized negative impact on Q2 earnings and the full-year outlook. Risk 5. Debt refinancing risk. CHDN's debt maturities and the interest rate environment will determine the cost of refinancing. Rates remaining elevated through 2026 and 2027 could increase the interest burden if the company needs to roll debt. The watch point for Q2 is simple. Kentucky Derby weekend handle, attendance, and hospitality revenue. That's the number that moves CHDN stock more than anything else on the calendar.
What is the bottom line on Churchill Downs Incorporated? Q1 2026 was a solid beat-and-run quarter. Revenue of $671 million, up 4.4% year-over-year, beating estimates. Diluted EPS of $1.07, beating by 6%. The stock sits approximately 25% below its 52-week high of $118.46.
The honest assessment. Churchill Downs is a high-quality gaming empire with an irreplaceable asset at its center that's being discounted by the market because of its balance sheet. The debate is not about whether the Kentucky Derby and the HRM franchise have value. They clearly do. The debate is about whether 4.5 times net debt to EBITDA at current interest rates leaves enough earnings power for the equity holders to be adequately compensated. At 13.5 times forward earnings and roughly 33% below the Street's consensus price target, the risk-reward tilts toward the bulls. But the leverage has to come down, and it has to come down without a disruption to the Derby or the HRM regulatory environment. The key metric to watch is Q2 2026 Kentucky Derby weekend handle and revenue.
We'll leave you with CEO Bill Carstangen's message to investors for 2026. Our first quarter results reflect the resilience of our diversified business model. Gaming, live and historical racing, and Twin Spires all contributed to a quarter that beat our expectations, and we still have the Kentucky Derby and the strongest event calendar of the year ahead of us. A CEO who turned a historic racetrack into a $3 billion gaming company, navigated the legal battles to establish historical racing machines in Kentucky, and is delivering steady beats in the weakest quarter of the year, while the Derby catalyst sits weeks away. That's the case for Churchill Downs at current prices. That's going to do it for this episode of Charged Alpha, your deep dive into Churchill Downs Incorporated, ticker CHDN. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.